Hi, this is CNN Vantage Point. I'm Philip Pro, Chief Investment Strategist with CNN Wealth Management. In today's podcast, we'll provide a market review for the month of March of 2023 and our current outlook. March was a month for investors to fasten their seatbelts. As the month began, the possibility of a 50 basis point hike at the March FOMC meeting came into play following Jay Powell's semi-annual testimony before Congress. Bond yields rose following his comments, with the two-year Treasury yield reaching a closing high of 5.05% on March 8th. Then financial markets were rocked by the sudden failures of Silicon Valley Bank and Signature Bank. Contagion fears permeated through the financial sector, with regional banks largely experiencing the most adverse impact. The S&P Regional Banks Select Industry Index declined 28% in March. Small caps also declined due to its financial sector exposure. Between financials and REITs, the Russell 2000 Index has a combined 22% weighting to these sectors, compared to 15% for the S&P 500. The Russell 2000 declined 4.78% in March, while the S&P 500 gained 3.67%. Treasury yields fell sharply in the days surrounding the bank failures as investors sought safety and believed the Fed would be forced to back off rate hikes. The two-year Treasury yield declined about 1% over a three-day period, a decline that hasn't been experienced since October of 1987. The Fed did raise rates by 25 basis points, but indicated rate hikes are likely close to ending. The two-year Treasury ended the month at 4.06%, declining 0.75% from the beginning of March. Ironically, the defensive play throughout the month was technology. Mega-cap technology companies became the safe haven as their fortress balance sheets and exposure to artificial intelligence were favored. The information technology sector of the S&P 500 gained almost 11% in March. The NASDAQ index, a technology-heavy index, returned 6.78% in March and finished the quarter with nearly a 17% return, its best quarterly return since the fourth quarter of 2020. But market disconnects still abound. Inflation appears to be receding, but at a slower pace than anticipated. Core PCE declined 0.3% in February versus its January reading of 0.5. Likewise, February's headline PCE came in at a 5% annualized rate versus the 5.3% rate from January. To combat inflation, the Fed needs to continue with higher rates, but the Fed futures market is pricing rate cuts as early as this summer. In fact, as of this recording, the futures market is pricing in a Fed funds rate of 4% by year-end. The current funds rate is at 5%. On the equity side, corporate earnings are declining, having dropped approximately 6%. However, market multiples have increased and now sit at 18 times earnings. One could justify this multiple if earnings were strengthening, but the current consensus for the next 12 months earnings growth is only 4%. We believe the Fed will only raise rates one more time and may take a temporary pause at their May meeting to assess the impacts on the banking sector. Even if the Fed doesn't pause, we're close to the end of the rate hiking cycle and have been more aggressive in our fixed income buying. Yes, short-term rates are attractive right now, but will they be at these levels in 12 or 18 months? We think it's unlikely and are looking to slightly extend our duration by purchasing longer-dated bonds. We remain cautious on equities and believe U.S. equity markets have gotten ahead of themselves. But if the Fed cuts rates, valuations may not be as overvalued as we suspect. With a wide dispersion of possible results, we do not believe investors should take high conviction bets. We remain neutral on equities, slightly defensive in our positioning, and made no portfolio changes in March. I'd like to remind listeners that market conditions are fluid and can change quickly, even daily. As circumstances and facts change, CNN's market views and portfolio positioning may change accordingly. If you would like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. If you like this podcast, we'd be grateful if you share it with your friends. On behalf of the entire CNN Wealth Management team, I thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.